Welcome to the Deep Dive. We have a very special analysis for you today, a custom deep dive into Apollo Tyres Ltd. It's a full discounted cash flow model, built just for you. And let's just get right to it. The headline takeaway is incredibly bullish. The model pegs the intrinsic value at INR 635.84 per share.
Which, compared to the current market price of around 512, suggests it's undervalued by, what is that, about 24%?
A cool 24.1%, yeah. That's a pretty big number.
It's a very big number for a traditional manufacturer. So our job today is to, kick the tires on this bullish conclusion. We need to figure out what critical assumptions are holding this whole thing up and, whether they're actually realistic.
Okay, let's unpack that. What's driving such a strong valuation? I mean, a 24% undervaluation needs some powerful forces behind it.
It's really built on two core pillars. First, you have these huge macro tailwinds in India. The DCF model, it actually uses a 7-year forecast period, which is pretty long.
Longer than usual.
Right, and it does that to capture a projected 10% compound annual growth rate for the entire Indian tire industry. That's all backed by, very strong Indian GDP growth forecasts.
Okay, a booming market. That makes sense. What's the second pillar?
The second pillar is the company's surprisingly low systematic risk. The model uses an adopted levered beta of just 0.35.
Wow, 0.35 is very low. So for you listening, beta just measures how much a stock moves when the whole market moves. A low number means it's seen as very stable.
Exactly. And the reason for that stability, or perceived stability, is Apollo's business mix. A lot of their revenue comes from the replacement market. It's just a much more stable, higher margin business than selling directly to car manufacturers.
But wait a second. If the company is so stable and low risk, why is its free cash flow history all over the place? I'm looking at the numbers here and they seem really volatile.
Now you've hit on the single biggest leap of faith in the model.
The contradiction.
The contradiction. It's what we call the operating cash flow margin normalization. If you look at the recent history, the free cash flow, or FCF, it contracted by a massive 61.08% in just FY 2025.
61%?
Yeah.
In 1 year. That's not a dip, that's a canyon.
That's a canyon, exactly. It crashed from about 27 billion INR down to 10.5 billion. The model doesn't ignore that, but it assumes a very, very strong comeback.
A V-shaped recovery, basically.
A perfect V-shaped recovery. To get anywhere near that 635 rupee target, the model needs their EBIT margins to stabilize at a healthy 8.5% by FY 2028. And crucially, it also requires much higher capital expenditure, about 6% of revenue.
So it's assuming they can spend more to grow more, all while fixing their margins after a historic crash. It sounds delicate.
It is. The whole valuation is walking a kind of technical tightrope.
So how sensitive is that final number? I mean, how easily could that 24% discount just disappear?
Very easily. The valuation is extremely sensitive because the WACC, the weighted average cost of capital at 8.73%, is very close to the terminal growth rate of 4.0%. That spread is quite narrow.
So small changes have a big impact.
A huge impact. Let me give you an example. If the WACC were to rise by just 50 basis points, that's 0.5%. Maybe interest rates tick up or something. The intrinsic value immediately drops from that base of 635.84 INR all the way down to 595.73 INR. The margin for error is tiny.
And we have to be really clear about that low beta, the 0.35 figure. That wasn't actually calculated from Apollo's own stock history, was it?
No, and that is a critical technical point. That low 0.35 figure was adopted. It's a consensus number. The standard 5-year regression analysis just couldn't be performed.
I know.
We simply didn't have enough data. Only a few months were available. So a key ingredient that makes the company look low risk is, it's borrowed. It's not built from its own recent performance.
So the final takeaway for you is pretty clear. This intrinsic value of 635.84 INR is, an optimistic forecast. It's tied very tightly to a big long-term growth story in the Indian market.
Right. Which leaves you with a really important question to think about. Given that this entire valuation hinges on a perfect margin recovery, reversing that spectacular 61% cash flow crash, and on a beta that's borrowed from consensus, not built from data, how much of this high value is based on real market signals versus just a bet on flawless management execution over the next 7 years? Something